Just love rock and roll. Good morning, everyone. Hope you're doing good. Hope the family is good. Hope the business is good. Hope you're feeling good. Most important thing. So in case you haven't been watching market news, just kind of want to bring you up to date. So I'll go ahead and jump right into it. So here we have good old inflation rate. Currently stands, it was announced last Thursday. It came in at 8.2%, down 0.1% from August. So not, I mean, it's sticky. Came down somewhat, I guess. And the Fed is fighting inflation, so they say. You got the Fed rate currently at 4.5%, and 30-year fixed mortgage rates at 7.63%. It's crazy how quickly they've gone up. So it seems as if there's still more room to the upside in rates to be able to bring this bad boy here down. On another note, which is good, this is good news. Social Security benefit will increase for 2023 by a whopping $140 a month. I don't know. Hopefully, inflation is a lot lower by then, but that doesn't seem like, enormous increase, which it is for Social Security, being that Social Security, unfortunately, is, I would say, technically bankrupt because they're paying current retirees that are on Social Security via the taxes or the Social Security taxes imposed on current day employees. So current day workers are paying for retirees Social Security benefits because the government unfortunately has used the funds to finance other necessary things. So basically the Social Security benefits or accounts, whatever it may be, is more of like an IOU where they're currently depleting it based off of current employees, and the ratios are declining, and current employees are paying current retirees that are receiving Social Security benefits. So it's unknown whether this will last into the future, is what I'm trying to say. So I mean, this is good news. I guess it's gone up quite a little bit, and most has gone up in a very long time. Whopping $140 a month, better than nothing, right? And it's basically, they're saying that, the CPI, the Consumer Price Index, which is basically the inflation rate, is pretty elevated. And in order to help people with the cost of living, they're increasing Social Security benefits, which again, better than nothing, right? And then on another note, Fed raises rates again. This happened on the recent Federal Reserve meeting, which occurred on Wednesday, September 21st. So they bumped up rates another 0.75%. So it went from 3.75 to now 4.5%. It's current Fed rate. So Fed rate has announced that they signaled that they remain hawkish. Hawkish meaning they plan on continuing rate hikes until 2023, where the terminal rate endpoint of 4.6%, which is kind of confusing what they mean by that when rates are like currently somewhere between 4.2 and 4.5%. So they're saying that they signaled to continue rate hikes until levels hit the terminal rates or endpoint of 4.6% in 2023. So that implies a 1/4 point rate raise next year, but no decrease. So they plan on keeping rates high, but they don't want to cross the threshold, which is 4.6%. It's kind of weird because we're almost there. And considering that inflation's at 8.1%, it's kind of and it's being sticky. It's kind of a interesting situation. So yeah, rates have not been this high since 2007, 2008. I'll kind of show you that in a little bit. And yeah, they keep pointing out to the terminal rate, the 4.6% threshold that they do not want to pass. And I'm curious, the reason they might not want to pass that is because they probably have all these calculations and all these charts and statistics and whatnot saying that if they might pass that point, it can potentially create some sort of crisis. So that's just my curious guess. And then on a good note, it's good for inflation. I mean, for reducing inflation, but bad for the market. So the federal deficit fell by 1.4 trillion in the fiscal year 2022, basically meaning that the Fed is purchasing less assets. Most likely they're reducing their mortgage-backed security purchases and treasury purchases, which now reduces the deficits. Is basically they're spending less money on assets. It's what they're saying. That should bring inflation down, as long as they continue this trend. However, it is bad for the market because if the Fed, you want the Fed to be your friend. If the Fed is in the market buying things, that means appreciation for you. If the Fed is not in the market buying things, that means depreciation for you and your assets. So it's an interesting situation. So let me see here. Yeah, so let me kind of jump into the charts and kind of give you an idea what the market is looking like. Right here we have the major indexes. The Russell 2000, NASDAQ, S&P 500, and the Dow. They seem to be downtrending. Today they rallied a bit, I assume, because earning reports come out or start coming out this week, and they're on after. So investors are optimistic, and hopefully, as long as no bad earning reports come from a major company or industry, this rally might continue. However, the market has been very sensitive. So if some potential bad earnings report for a big company comes out, it might have a dramatic effect, causing the market to sell off. You have here are the major indexes. They're kind of, from what you can see, they're all downtrending, which is bad again for everyone, because for the most part, everyone's retirement accounts is invested into one of these major indexes in the United States. Again, housing prices continue to drop month over month. This chart here is pretty scary because it's just like a rock that just fell off a cliff. I mean, it just keeps going down. And this is the United States case Schiller Home Price Index, month over month prices. And I mean, you don't need to really know much about charts, but you can kind of see clearly that this is trending downward. And I just lined this up over here to give you an idea where the bottom of the market was in 2009. That was after the 2008 crash, how low or how quickly or to what level month over month prices reached for real estate. And this is interesting to me, how this is just like dropping like a rock. And I'm just curious because there's no bounce. It hasn't bounced at all. It's just literally just straight down. I'm curious how low this thing would go, because again, I keep saying the futures market, derivatives tend to foreshadow what is going to happen in the real market in the future. Not always, but a lot of the times it does. For example, look at oil prices. If you want to get an idea how expensive oil prices are going to be, you look at the derivative market, the futures market, crude oil, and you kind of get an idea where oil prices are or where they should be. Same thing over here with real estate. And then again, the good old dollar. This thing's a beast. I mean, it's just been like on a rocket ship straight up. Kind of noted back here, this was 2002 towards like I believe the bottom of the dot-com bubble. So you can kind of see the correlation between the dollar and assets. They're basically inverse. Dollars up, assets have to be down because that means your dollar can buy more because it has more purchasing power. So interesting here that the dollar is reaching and is at already dot-com bubble levels. That again is not a good thing. You do not want the dollar going up if you own assets. You want this thing to go down. The lower it is, the more your assets is worth, if that makes any sense. And then, of course, the 10-year yield, U.S. government treasury bonds, again, rocket ship. And this is, again, one of the reasons why the dollar is up as well, because rates are up. Rates are up. That means it's more expensive for you to borrow that dollar to purchase whatever it is you're trying to purchase, because typically that means you're getting a loan. And that means the loan has a higher interest rate. Therefore, the money or the dollar that you're borrowing, the dollar amount you're borrowing, is more expensive because you're paying more money to borrow that X amount of dollars. So 10-year yield, straight rocket ship up. It's again nearing, as the article was saying, 2007 levels. So I'm curious because every time something dramatic happens in the market, where some sort of crisis occurs or something like that, and I believe around this time was when the Lehman Brothers went bankrupt. It was September of 2007, and that caused the whole panic in the market. And of course, at the time, Federal Reserve Chairman Ben Bernanke dropped rates. He went into stimulus mode, dropped rates, print money. And as you can see, when rates drop, U.S. Treasury bonds go down in interest rate, what they pay out. Their value goes up. They go up in par value, but their interest rate goes down, what they pay you for holding the bond. So yeah, that's kind of keeping you up to date and kind of giving you, the see it with your own eyes, kind of look at the charts and where prices are and interest rates are. As you can see, the 10-year yield is almost at 4%. And this is a good one to watch in terms of where potential inflation rate might be in the intermediate term. So yeah, let me know what you think. Maybe you've seen some things out there that I'm not seeing. So feel free to shoot me a message, and hope you guys have an awesome week. All right. So I'll talk to you guys soon, and enjoy your week.